I don't think it's necessary to collect a dividend to compound money over time. I think, I mean, there's different schools of thought around this, but from what I've seen, the best way to do well over time is to own the best sort of combination of value plus growth. So value starting points with high return on invested capital. And so whether the companies return their excess capital or buy back shares with it or redeploy it into acquisitions or organic growth, all of those can sort of be factored in to what the ultimate return on investment will be. But I don't think that dividends specifically provide much protection from downside.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome to the Money Level Show. Here we think, act, and prosper. This channel focuses on changing financial trajectories and building legacies. Today I am joined by my good friend Benjamin from the ROI channel. His channel will be linked below in the description as we engage in this interview with Josh Young. Josh Young is the Chief Investment Officer and founder of Bison Interests. Bison Interest does a lot of research in the oil and gas industry. Josh has over 15 years experience in investment management, and 10 of those years come from the oil and gas sector. So today we're going to get Josh's perspective on supply and demand, where he sees the oil and gas prices going, as well as specific companies where he sees opportunity lie. So without further ado, let's get to the interview.
I know you're a fan of Mr. Buffett, particularly in his early career. For those factors that you mentioned in terms of the ability to compound rates at superior rates of return in the smaller sector, are these examples of the type of companies you think Mr. Buffett would be buying if he were running, obviously, a much smaller book with less restrictions around the size of companies that he has to buy?
Buffett did buy companies like this back in the 50s and 60s, and people just don't like talking about this stuff. I don't know why, but I guess because oil's hated so much, and people say, oh, well, he bought Conoco in 2008 and it did badly, and he bought XYZ company in 2014. Sure, okay. And he also bought, I'm forgetting the names of it, but he bought some oil services company in the 50s, and it was like a 50x. And Munger was in with this other one that was a 20x. I mean, just nonsensically incredible returns. Some of the best investments Buffett ever made in individual stocks, not See's Candy, but individual stocks were in the oil and gas sector. And the highest percent returns were back when he was running money similar to the amount of money that I'm running. So, adjusted for inflation, his sort of running $10 to $50 million in 1950s money. I mean, he did so well. And a lot of that, not all of it, but a lot of that was oil and gas. And you have to sort of parse through his letters because he doesn't always talk about exactly which things he owns in them. And then there was sort of a higher turnover rate than he sort of, I think, wanted people to think. He had sort of a 50% turnover rate because, there were a few things he owned a lot of for a long time, and then a lot of things where he'd sort of get in, get his double, triple, whatever, get out. And then I think there were other things he just didn't want people to tag along with. But then you find materials, or you find his, the Snowball or some of these other books where they'll talk about some investment. It's not in any of his letters, but it was like a 30% position for him for a period of time. So the oil and gas stuff is like that, I think. And some of it they wrote about, some of it is just sort of very obscure, we found from different places. But yeah, I think Buffett would be all over. I'm not sure. I can't say he would own any one particular company, but I think this sort of thesis, you get these companies at really low multiples that are growing or just dramatically improving their debt adjusted per share, cash flow, reserves, in some cases production. I mean, I don't know, that's as much a Buffett investment, I think, as you can get. And sure, there's some left tail risk, right? If oil prices crash, if gas prices crash, whatever. And Buffett has experienced downside from his style of investments too. And him and Munger say, look, if you can't, I think Munger said, if you can't experience a 50% drawdown twice, then you should not own public equities. So, even more true in oil and gas, but that doesn't mean you shouldn't invest in it. It just means you should expect significant volatility.
Yeah, thanks for sharing that, Josh. So I had a question on So obviously the small caps can rip. I mean, I've seen Vital Energy, I mean, it was at $40 or something recently and then ripped up to 60 something bucks. Um, and obviously the bigger market caps, like you're not going to get as much growth in those stocks. However, like, I kind of, trying to help my audience understand, like, the difference between, like, because you can compound with some of the so like I'm in some of the pipeline stocks like Energy Transfer, Enbridge and such, but they pay like high dividends. So how do you balance that, or are you mostly small caps, or do you compound with the high dividend payers? Hello, everyone. Sorry for the break in action, but I want to tell you about the link in my description below. This is to the New Orleans Investment Conference. This conference has been around for years and have brought many people out, such as Milton Friedman, Gerald Ford, Alan Greenspan, and Margaret Thatcher. This conference is put on by Brian Lundeen and his team. Brian is the CEO of Gold Newsletter. This year, they're going to have speakers such as Jim Rickards, George Gammon, Peter Schiff, Rick Rule, Danielle DiMartino Booth, Lynn Alden, and many others. Now, I encourage you to click the link in the description below. You can choose to attend the live event, which I will likely be at, as well as the event that is live streamed. You can support the channel by using my link below, so I encourage you to check that out. Now, let's get back to the interview.
I don't think it's necessary to collect a dividend to compound money over time. I think, I mean, there's different schools of thought around this, but from what I've seen, the best way to do well over time is to own the best sort of combination of value plus growth. So value starting points with high return on invested capital. And so whether the companies return their excess capital or buy back shares with it or redeploy it into acquisitions or organic growth, all of those can sort of be factored in to what the ultimate return on investment will be. But I don't think that dividends specifically provide much protection from downside. For example, I think you mentioned Enbridge. I think they were the one. There was a big Canadian pipeline company that went in and bought a few utilities this past week, and their stock fell considerably because it was sort of a thesis drift. Part of the problem with companies that pay dividends is that often they're paying dividends because there aren't great organic reinvestment opportunities and there aren't great acquisition opportunities. And so one of my biggest investments in Canada is a company called Journey Energy, which I'm not recommending, but I'm going to use it to answer this question. So Journey has some competitors that pay high dividends because they're a low decline oil producer and they go and buy fields and fix them and then just sort of keep them real flat. They require, I think they're spending something like $10 million this year while they're generating, I think their run rate right now for operating cash flow is close to $90 million. They're spending 10 and their production's maybe going to fall a couple percent, but it's basically flat while spending, 15% or something of the operating cash flow to keep production roughly flat. So that's a very interesting setup, right? So the question is, what do you do with the money? So a lot of their peers have been paying out their free cash flow as dividends. So you look at a Cardinal or an i3 or whatever, or a Gear. And then the problem is if you pay it all out as a dividend, if you ever have to cut it like i3 and Gear did, your stock gets crushed and you destroy your credibility. And then you raise questions about how well you're actually managing the business and how well the business is governed and sort of, so you have real sort of credibility and other problems if you actually try to pay out the excess cash flow and not grow at all. And then when you look at the potential returns, so you look at a Gear, right, they were paying at one point, I think it was a little over 10% dividend, while they were supposedly, paying out a roughly 60 or so percent of their operating cash flow. And so if you look at them versus Journey, so Journey was not doing that. They were paying out zero dividend, but instead what they were doing with that money is building power plants that, in my calculation, not theirs, and maybe I'm off by a little, are earning somewhere between a 5 and 10 times return on investment. And let's say it takes about 2 years for them to deploy the money versus when they get turned on. They're supposed to be a year, but there's regulatory delays. Maybe it even takes 3, but if they can go and earn 100% of the money they spent every year after that, right? So the discounted cash flow on that might work out to be I don't know, 40% or 50% IRR, but it's even better, right? Because, on an undiscounted basis, your MOIC, your money invested versus the return on the money invested in absolute dollars might be 7x or 15x or whatever. So you're so much better off, in my calculus, investing in your business if you have that sort of ultra high return. But you go and talk to some of these management teams and they're just not, they say, oh, it's not my wheelhouse. It wasn't Journey's either. I sort of helped convince them to do it, but now it's part of their wheelhouse. They learned how to do it. They spent some money on it and they looked real dumb for a little while. And then they turned on a small plant and now they're turning on bigger ones. So the point of that is, if you look at some of these companies and they're paying a 7% dividend or 6% dividend or 10% dividend, you feel like you're getting some money back and it's safer. But the reality is that there might actually be a really high opportunity cost versus going in, an extreme case, right? Journey's power gen is just extraordinary. They've done such a great job on that. But even if you look at sort of an average case, you look at the average return on investment in upstream in Canada over the last, let's say, 2 years, right? You drilled an average well, you got average productivity out of it, so average cost, average productivity, your return on that is probably around a 35% return. So it's way over that 20%. And that's on a full cycle basis, inclusive of land and all that other stuff. So are you really better off paying a 10% yield as an upstream company versus going and drilling a well at a 35% return? And yeah, as a shareholder, you have that money in your pocket instead of having it reinvested in the business. But if the goal is to have ultimately sort of the highest discounted earnings and cash, right? I don't necessarily need that back in my pocket. I just need that value created. And then ultimately, eventually, the market to be a weighing machine instead of the sort of short-term voting machine to be able to reflect that value. So I think it's similar on the pipeline side. There are some companies that on the infrastructure side that reinvest a lot of their money. And then there are some that pay out a lot in dividends, and then there's some sort of balance. And I think my preference is to own companies that have really high organic reinvestment opportunities. And at least at this part of the cycle, especially when I can buy them at really, really low valuations. And so I don't think it's really a question of compounding or not, because I think you compound by getting great investments and holding them. I don't know that you necessarily compound by owning something that's paying you a dividend. And again, what matters there is the return on the invested capital over a cycle.
Yeah, that's really good. Appreciate you sharing that. So I did want to jump into a company that I've bought for a while. I'm thinking about selling them, but Suncor Energy. I mean, they're a bigger market cap. But I'm seeing all this like information of some companies like this going into like the green energy space and such, and I don't know if it's just for like political show or what, but what's your take on like companies like this, dabbling in more of the green energy space or wanting to transition towards that direction?
So Suncor is really interesting. I've commented on them a few times publicly over the last few years, and it's been a very contentious company. Activists have been involved and they replaced the management team. The company actually was heavily investing in alternative energy and they stopped and they sold off that business line. And so I actually really like it. The thing I don't like is that the valuation is not that compelling in my assessment. It doesn't meet my hurdle of potential return. And I understand there's less risk, but I don't find it that compelling. That being said, there's a great new CEO who's in there who I think he was at Imperial Oil before and has done really well. They have assets that will be around for many decades, and they've required some operational improvements, but the new CEO is very capable of making the changes that are necessary. And it's really hard to change cultures. I took control of a publicly traded company and we had to unfortunately let go of a lot of the people to shift the culture. And he's not doing that. He's letting go of only a few people and just sort of forcing changes. And he's been doing a pretty good job from what I can tell. So I feel like I can like a company a lot while also not owning it because it doesn't meet my valuation parameters. And so I'd say that's a company that sort of achieved a really effective turnaround, has actually divested from alternative energy investments like you were talking about. So they've gone the other way from what you were saying. And I just don't own it because it's too expensive for me. But I understand why people own it, and I certainly wouldn't tell people. I mean, I'm not giving any sort of advice. They can buy it, sell it, whatever. But I could understand why people would like it here, and I do think it's a little more compelling than some of its peers of that sort of size. I think it's if I had to own a company of that size, I'd probably own Suncor over Cenovus or Canadian Natural Resources, which are sort of the two, or Imperial Oil, which are sort of the other ones of that size.
Gotcha. Go ahead, Ben. You want to chime in?
I would like to talk about. So I really appreciate the point on return on invested capital, and I think to me the way I look at it is, well, can I compound capital better than Alex Verge can, the CEO of Journey? And the answer is simply no. So if I'm a little bit patient and can exercise some delayed gratification, go without a dividend, having someone compound that money for me is certainly what I'm about. Are we okay to switch gears into something that's very topical, particularly an article of Bison Interests talking about Pipestone? Josh, if you wouldn't mind, just give us a brief overview of the company and what's happening recently with regards to this proposed reverse merger.
Hey everyone, sorry for the break in action, but I have to let you know that I am now an affiliate with Miles Franklin. Miles Franklin has been a bullion dealer for over 30 years, and they provide some of the highest quality service to their clients, as well as fair pricing on bullion products. So purchasing bullion through Miles Franklin not only stores wealth for yourself, but you're also supporting this channel to continue to provide free educational material for retail investors and those who may not be aware of many financial concepts that I discuss on this channel. So you can get started by sending an email to info@milesfranklin.com or calling 952-929-7006. Be sure to let them know that Daryl Thomas or the Money Level Show sent you, and I will receive credit for your service. I thank you all for considering this. Now let's get back to the interview.
I'd really like to delve into it if I could.
I've turned down a number of interview requests on this. I think I'm going to stick with that and pass. I think it's a great question, and we engaged in very limited discussion of it beyond sort of what we've put out in writing, just to avoid various potential landmines. So I'll just hopefully that's okay to defer on that.
Yeah, no problems. I just I really like the article and wanted to delve into it. In that being said, if we come back to the point around gas, why is gas such a nuisance when it's so valuable of a fuel source? And I guess some of the impetus to setting up this conversation was my question to Rick around Canadian small caps. His comments were around there's a time value of money problem, but I think that you may have answered that given the fact that you are you're being compensated for the time value of money by the fact that some of these management teams are compounding them at such compelling rates of return. This arbitrage between, say, Henry Hub, US gas, and the rest of the world, and liquefying natural gas, is that a space that is of interest to you and the amount of infrastructure spending that needs to happen over the foreseeable future?
Yeah, I mean, it's very interesting to me. It's not pulling a lot of my dollars. Goldman came out, I think it was a couple months ago, in an interview. Their head of global gas research talked about how there might actually be an LNG glut in the next couple of years. And when you look at the amount of construction of LNG import facilities, along with power generation tied to that, versus the amount of LNG export and tanker building, there's sort of a mismatch. So there is a risk that we build it, but if we build it, someone doesn't come. And so, and there is an undersupply right now, but it's very easy to go from undersupply to oversupply in commodity markets. And so I think it's worth sort of keeping that in mind, because there's a lot of, I think, hope around these LNG exports, and frankly, a lot of them are getting delayed. So some of this is getting solved just by export construction getting delayed by a year or two on various large projects and cost overruns and so on, which is giving it's giving some of the potential users of this gas time to go and build more stuff. But there's a risk of that. So I'm not that interested in investing in the infrastructure because I think there's a pretty good chance of there being an oversupply, or at least a more balanced market where some of the folks that were providing it have been over earning. And I just would rather get into stuff when everyone hates it than get into stuff when everyone knows about it. And then you start seeing smart people who study the market really closely waving their hand and saying, hey, there might be a problem. So that's, I think, a thing to be aware of. That being said, I don't hate US or Canadian, which in some cases is actually even more discounted than US natural gas production at current spot rates, right? At 250 or 260 an MCF for gas at Henry Hub, or $2 or $1 or something in West Texas, and $1.50 US in certain parts of Western Canada that the producers are getting. I mean, there does seem to be a lot more upside than downside for that. I just don't want to have to pay for it. So, I'll take it. I'll take as much of it as I can get. And if I can go buy these liquids rich gas companies, or, half and half oil and gas, and pay almost nothing on a run rate basis for that gas and those cash flows, I will take it. And that's, if you look at some of the names I've talked about publicly, there's not an accident. It's not an accident that we have a lot of exposure to gas that, in my estimation, we're paying almost nothing for.
Hard to beat 100% free upside, I guess. Leading into what you mentioned, my next question was around the tanker market. Do you see any value in the tanker market? And are you leaning towards, say, crude versus products? What are your general thoughts on tankers at the moment?
I'm not an expert in it. I've invested historically. I have a mixed record investing in it. There are folks who are really smart on it, who seem to like product tankers here and like oil tankers a little less. I do think it's interesting. About, I think 6 months ago or so, everyone was bullish oil tankers, and the stocks and tanker rates have fallen since then. So it's just one of those things where when you see everyone bullish on something and positioning all on one side of the boat, that's like a big red flag. It's not even a yellow flag. It's scary. And so, when you turn on CNBC or Bloomberg and everyone's bullish oil, it's a little scary. We're not anywhere close to that. They're still talking about it going away. But, when that sort of thing happens, it's good, I think, to be aware of these sorts of things. And, I noticed that. And that's, I think, the most intelligent thing I can say about oil tankers, which is just a little while ago, they were really popular. The stocks have been falling since then. There's oversupply, I think, currently in oil tankers, but there's not a lot of new builds. And when OPEC does bring production back on the market, eventually you're going to see more tightness. I just don't know when that'll be, and I don't know what my edge is on that.
Yeah, it's funny you said I'm not an expert. I say that to myself all the time, but it doesn't stop me from speculating. I just look at, as you mentioned, the new builds seem to be all booked out, and the supply seems to be non-existent, at least until 2026. And some of these that I have my eye on appear to be trading at a discount to their steel value. So I thought it'd be interesting to get your thoughts. I know you like to look at a net asset value, and if you can get a really good entry price on that to a company that has upside, that it might be in your wheelhouse.
Yeah, I don't think that they trade nearly at a big enough discount to their replacement costs or net asset values to really attract me. And where I see some of the folks that do know a lot about this sort of sharing some of their work, some of the more inexpensive ones that they're excited about are at 70% of the net asset value. That's frankly like where I would go to sell some of these sorts of things if I were to get involved. So again, not saying they're wrong. They may be right. They've done really well. I just don't know what my edge is on it. And there's just such great, I can go buy producers at 2 or 3 times cash flow, or, a Journey at 4 times cash flow, but I get huge gas power gen turning on in 6 months and essentially free natural gas production. And they keep doing these accretive acquisitions. I don't know. I mean, I just feel like my cost of capital is really high, and the opportunity cost versus, investing in something at a 70% of net asset value. I'd just rather invest in these great opportunities that I think I'm an expert in.
Wise words, very insightful. DT, anything you want to chime in on?
Oh no, I mean, I feel like this conversation is going really well. I'm learning a lot. I'm learning to follow Josh. Josh is going to the other side of the boat when everyone's running to the other side of the boat. So Josh, if you don't have anything else, I was gonna go ahead and close this out. But Josh, where can people find more about you and more about the services you offer at Bison?
Sure. Yeah. So you say run to the other side of the boat. We say face into the storm. But yeah, same idea. I have to say it's pretty unique to get interviewed by a guy in a bathrobe and a guy in a Ninja Turtle t-shirt.
It's a cardigan. It's a cardigan.
Okay, sorry, cardigan. Cardigan bathrobes. I don't know.
Speaking of my tie.
But I have to, I just want to, for a second, I think it's pretty cool to do this. I got to see your recent interview of a commodity expert, which was pretty exciting in this sort of format, and some of your guys' other interviews. And it's really exciting to see new folks come into sort of the financial information space. And I like how you guys are approaching stuff, and you've had some really interesting guests so far. So it's really cool to get to be on here. I appreciate you having me on. And I have to say, so I feel a little better that it's a cardigan and not a bathrobe, but it's still a pretty unique and interesting experience.
If that's what it takes to get guests on, that's what I'll do.
Hey, so yeah, bisoninterest.com is the website.
There.
What's that?
I said Ric Flair over there, Val Venus or something. What is going on over there?
Whatever works. So yeah, Bison Interest is our website, at Bison Interest on Twitter or LinkedIn. You can follow me on Twitter. Just look up Josh Young and you can find me. And and like 20 of the impersonators, Elon Musk is doing a great job there. So, But yeah, thank you guys very much for having me on. Really,
man, appreciate you coming on for sure. My audience, I'm trying to reach the average person, get them involved into the natural resources. I heavily believe in the sector, the commodities bull market. And so it's good to have experts like yourself come on. And people are getting top notch quality information and information we can go back and do our research on. I'm learning throughout this process. And so this whole interview, I'm learning stuff and I'm bookmarking things to go back and do some more research. So I love having interviews like that. So appreciate you.
Great. Thanks a lot, guys.